All right, all right. Here we are once again, every single day. Every day we like to come and watch the ponies run every morning, every morning. What ponies are we watching run today, Lan? Well, up in the upper left-hand corner, we have the S&P 500. In the upper right-hand corner, we have the mini Dow. And in the bottom right-hand corner, we have the micro NASDAQ. And in the bottom left-hand corner, we have the mini Russell. What do you mean mini Russell and micro NASDAQ? What are those? Well, we're in the futures market. And in the futures market, we have mini contracts, we have micro contracts, a little bit different than over in the stock market. We're out of Chicago here. This is the Chicago markets. What? What are Chicago markets? Yep, we have futures markets and we have stock markets. And stock markets are out of New York and futures markets are out of Chicago. So this is an exchange, you might have heard of it, called the Chicago Mercantile Exchange. We also have the Chicago Board of Trade. These are also exchanges that you can trade on. Not everything is done out of New York. Believe it or not, the whole world doesn't revolve around New York City. Although what's interesting is that these are stock indexes that are traded out of Chicago, which are stock indexes out of New York City. So a little bit of crossover there, but that's okay. We can still trade them over here in Chicago. So we trade the indexes. We don't trade the individual stocks. If you want to go out and trade Microsoft or Apple, you have to go and do that over on the New York Stock Exchange or on the NASDAQ, right? Or on the AMEX. There's 3 exchanges over there in New York that are our primary exchanges that we work off of for stocks. But this is the futures exchange, futures market, and we do trade the indexes over here in the futures market. For those of you who haven't been here before and haven't been in my classes, that's just a little introduction to what we're doing here. My name is Lan Turner. I'm a former instructor at the Chicago Mercantile Exchange and the Chicago Board of Trade. I taught at both of them, actually. And I'm currently an instructor at Utah Tech University. I teach at the university. And these are the classes that we come to after my university classes, and I help my university students learn how to trade. This is kind of the applied application of what we learn in class. Now, that said, we are doing it on YouTube, so everybody in the whole world is welcome. And those who are not just students from my class, welcome. I'm certainly glad to have you. And we love to have anybody who wants to come and attend and learn how to trade these futures markets. We focus, I would say, probably 75% for those of you who have been here. Probably focus 75% of our attention in the futures market, but we do a lot of stock market trading as well. We have stocks that we are following, and we like to trade options. So we do a lot of options in this class, but primarily first thing in the morning, 7:30, when that morning bell opens out in New York City. We like to watch that morning bell here in Chicago. And so in Chicago, we're watching it on the indexes, and we can trade these, of course. And so these are leveraged markets. All right. This is called a hedging market. And so the idea is that these are heavily leveraged so that you can use them to counter the moves that are going on over in the stock market. But you don't have to do that. You can just outright day trade these because you can make a lot of money with a small amount of money. And that's the whole idea. If you're hedging, you can't hedge with the same amount of money that you have over in the stock market to hedge over here. What do you mean hedge, Lan? I don't know what that means. Well, that means that if you have a whole bunch of stocks and the market starts to fall, let's say you have $1 million in stocks over there in the stock exchange. Let's say you have $1 million worth of the S&P 500 and it starts to fall. Well, you can't just jump out of your $1 million. That's really difficult to do. So what you do is you come over here to the futures market where it doesn't take very much money to take a short position, and you got high leverage and you just short one. You just short a contract over here and away you go. The market starts to fall and you start making money over here. And if you make those equal contracts, you can make as much money over here as you can lose over there. So it's called a hedge. So you don't lose any money overall. And that's kind of the idea of these markets. And that's why you have them here. And that's why they kind of do what they do. All right. That's why we have this huge leverage. You talk about huge leverage, Lan. What do you mean when you say huge leverage? Well, let's come over here to the key. And this is kind of the key to the whole thing right here. You can see the key comes in here and says that we can control $195,000 with one contract, right? So one contract represents $5. Dow Jones current is 39.02. One contract is 39,000, equal 195,000. One tick and a minimum move, points, dollars. DJ is worth $5 per contract. So you can come in here and with your day margin, $750, you can control $39,000 worth of stock. What? One contract? Yeah. So you put up $750 and you can control $39,000 worth of stock. This is the S&P. So now you're controlling $5,000. Right here, you're controlling $39,000. Right? So if you can control $39,000 with $750, if that market over there starts to fall, you put up $750 here, and then you can make as much money as $39,000 is losing over there. So it's $39,000. That's pretty cool. That's for the Dow. The S&P, a little different, 5,000. The NASDAQ, now this is micro, so it's 18,000 on the micro, and then 2,000 on the Russell. I don't know if I'm reading that right. $100,000 on the Russell is what you're controlling. So that's your leverage. And so let's put that in layman's terms. What does that mean? That means that if you come in here and put in $750 right here on the Dow, and you would have bought right here at the very bottom and sold right there at the very top, you'd have made $360. So $360, well, it would have cost you about $39,000 to make that much money over in the stock market. Or if you're hedging, the whole idea, right, is, of course, you're looking for hedging is generally you're long the stock market and you'd be short the index over here in the futures market. So let's say, for example, this one here, okay, going down. So that would have made you $230 on the way down for a $750 investment. But on the way down over in the stock market, if you'd have had that have been $2,000, you'd have lost $230. I think that's this number here, 103,000. You'd have had to have no, that's not good. It's got to be 2,000. I'm gonna have to look at that again and see how come this is. See if I'm telling you the right thing. It's the leverage that you're doing over here, but that's the whole idea of these markets. But of course, if you're going to do the hedging stuff, you can do the hedging stuff. We have to figure out how much you're going to hedge against in these markets for one contract. I think that's what we're doing, though. $195,000. That just seems like too much for me. I think it's the $39,000 that we're hedging for one contract. But that doesn't seem enough over here. That's only $2,000 to hedge. Maybe, because Russell's a lot smaller. I'll double check those numbers for us. So anyway, the whole idea is that you can be short this market while you're long that market and make the same amount of money over here with a very small investment versus a very large investment over there. You don't have to sell out your S&P because you can just make it over here as the market falls. That's called hedging. Okay, that's what these markets were created for, and that's why we have so much leverage in here. But we as speculators, we're not hedging. We're just going to come in here and take advantage of the fact that we got so much leverage. And they like you to do that too. That's a pretty cool idea. So we're going to come in here, and what you can do is you can say, well, if I would have bought right here and sold right there, that's $175 on a $750 investment. That's a lot of money. That's good money. You'd have to have, I think, $39,000 in the Dow over in the stock market to make the same amount of money. So that's the point. That's why you can hedge over here with the money you have over there and protect it. That's the whole idea, right? Protect it. Man, that's a pretty cool idea. I got to learn more about that. Okay, that's what I'm trying to tell you. So you can go learn more. All right, I don't do a lot of hedging. I do more day trading and just take advantage of the leverage to day trade. That's what I do. And so that's what we're doing over here. So we like to watch these markets break out. And this is the morning bell. And so, of course, the morning bell, the market generally jumps all over the place. Now, this is a 15-minute chart up here in the left-hand corner. The 15-minute chart's going a little slower. I like that one because I generally like to trade options on the 15-minute chart if I'm going to trade an option. All right. The Dow, the market's not really doing much. It did nice. It started to show some promise down here, didn't it, in the NASDAQ? These are the 1-minute charts. So I didn't want to go on the range bars because they were a little bit too fast. Yesterday, we tried to do range bars, and the market was just going crazy. And so see, this is a range bar chart, a little bit different view, small. Oh, that NASDAQ's got bad ticks in it. We have to go clean that up. We had a bad connection to the internet or something. I don't know. But this looks a little, the Russell, Oh, this is the Russell. This is the, wait a second. Oh, this is the micro NASDAQ up here. I've got them out of order. You know me, I just kind of make my assumptions because I always have them in the same place. Top right-hand corner is the Dow. Bottom right-hand corner is the NASDAQ Micro Mini. Bottom left-hand corner is the Russell. So the Russell is the one that's kind of smooth again this morning. That NASDAQ kind of got some bad ticks on that range bar chart. We know how to fix that, though. We can go do that in a minute if we care. It's going to go off the screen, and then we won't care anyway. But the Dow's moving a little slower. But if you looked out on the marquee, I want to talk to you about the ABCD pattern. Now, we talk about the ABCD pattern in this class all the time, right, guys? You guys who are here all the time, we talk about the ABCD pattern all the time. So what's going to be different about that today? Well, for some of you, not a whole lot different because we've talked about it before. But for those of you who are new, and we have a lot of new people coming and showing up with us, I'm going to introduce you to the 1, 2, 3 ABC pattern. But for those of you who are regulars and who know what that ABCD pattern is, I'm going to teach you something new about the ABCD pattern. Okay? I'm going to teach you something new. So what is that new thing you're going to teach us, Lan? Well, give me a second. I'm going to draw you some pictures, but we'll watch the markets run here for just a second, see what they're doing. And then we will learn something new. I'm going to pull up my slide. I'm having a technical difficulty over here. I apologize. Having a little technical difficulty with my slides. Apologize for that. All right. Well, this range bar 6 is going a little bit too fast. Now, yesterday I said that, and the comment was, well, turn it up, Lan. We don't need to be a range bar 6. Let's go up to a higher range bar. Okay, there's range bar 12s. See if that'll slow it down a little bit. And then I had the other comment. Somebody said, well, why don't we just use 20-second charts, Lan? You said 20-second charts. I saw this guy on YouTube. He trades off of 20-second charts. And I said, well, I know who you're talking about. That's Ross Cameron. Ross Cameron trades off 20-second charts. I know Ross. Well, I don't know him personally, but I know of Ross. Ross is great. I love Ross. Ross, great guy. If you want to go watch him, go watch him. He's fun. He's probably one of the one of the only true traders in this whole industry that's on YouTube that actually trades real money. Nah, that's not nice to say. I'm sure that they all trade real money. But Ross is he's the real deal. He really is. But he's the guy that I was telling you, he's a scalping, he's a pump and dump trader. That's what he trades. He trades stock market pump and dumps. So he waits for the small $10 stocks to get pumped in the morning and shoot up 200, 300, 400%. And then he runs in there and tries to scalp out a couple little pennies out of it. It's really hard what he does. And so he trades on a 20-second chart. And go try it. I mean, heck, you want to get your ass handed to you, go try it. Ask me how I know. Well, it's really hard to trade like that. I mean, what we're doing is not easy. I mean, this is not easy either, but what Ross does is really hard. So, different strokes for different folks. And I like Ross. I like him a lot. Nothing against Ross. But he's a pump and dump trader. So if you want to trade pump and dump, that's the guy to go learn from. This is slowed down a little bit. These are range bar 12s. You can see they're not quite so wild and crazy. Range bars. I don't even know what you're talking about. Range bars, Lan. I'm new here. What's a range bar? Well, a range bar is a bar that is represented by number of ticks, not by time. There is no time involved. So like Ross might trade off a 20-second chart. That means he's going to get a new price bar every 20 seconds. And you think this is fast? Go watch a 20-second chart. Those are really fast. You're getting a new price bar every 20 seconds. Now, sometimes in this market, with a range bar, depending on how fast the market's moving, you'll get you'll get price bars a lot faster than 20 seconds, right? I mean, that's about what we're getting now on these, or even faster. We're getting them every 2 or 3 seconds. That's because in this market, a range bar only gives you a new price bar if the market moves a specific amount of moves. Now, a market can only move, it has to have a minimum move, right? I mean, what is the smallest increment a market can move? It's 1, right? Well, what does 1 represent? 1 doesn't represent 1 in this fashion that you think about it. It's not 1 penny like we might have in the stock market. What we have over here is 1 represents 1 contract, or a minimum move is a percentage of that contract. And so again, back to the key, if we come to the Dow, 1 minimum move is $5. So that's the minimum quantity. The minimum move is $5. So if it moves 1 tick, that's $5. That's the leverage you have. It's 5 times leverage of a penny, right? Or of a dollar. So you're getting, for every 1 move, $1 that it moves, 1 tick is $5. Okay. It's not pennies. It's not, you can't equate it that way because it's $5 for 1 minimum move. So just going up, down, up 1 tick, that's $5. All right. So the minimum move, and then we are saying range bar 12. So that means to get a new price bar, it has to go 5 times 12. So when it moves that distance, that's when you get a new price bar. And so you can get a new price bar. It might take 20 minutes to get a new price bar. It might take it 20 minutes to give you a new, for the market to move 12 minimum moves and then give you a new price bar. Or it might take, like there, it just took you 2 seconds to get a new price bar down there on the NASDAQ because it's set to range bar 12. And so if it moves 12 minimum moves, it's going to give you a new price bar. So it's kind of macro. It's very small. It's looking at it in a very small time frame. And the markets first thing in the morning, of course, they go very fast. They move a lot. So big moves because they're breaking out of that morning bell and they run all over the place. So they can go, you can get ticks every few seconds, 5, 10 seconds, 2 seconds, 3 seconds. You can get a new price bar. So you watch that NASDAQ on a range bar 12. So each time you get a new price bar, that means the market moved 5 times 12. That's how far that each one of those price bars represent. And so then you're like, well, $5 times 12, that's how big those price bars are. How much is that? You'd have to do your math. How much is that? $120 or something. Can you do 5 times 12 in your head? Everybody can, but me. 5 times 12. I don't like to do it in my head. $60. So 60, I guess I could have done 4 times 12 and added 1. So $60. So each one of these price bars is $60. So if you're going to put your stop 1 price bar back, you'd be putting it back $60. All right. That would be the idea. So right here, let's say what we think this market's going to fall. We'd come in here and we would sell, right? And then we're going to put our stop 1 price bar back. That would be about a $60 risk. This is the NASDAQ. So the NASDAQ is a micro. So it's going to be 1/10 of that. So it's going to be $6. Well, that was the Dow. We have to look at the NASDAQ key. NASDAQ is $20. So each price bar is $20. Okay. At a range bar, each minimum move is $20. But this is this is the mini NASDAQ. That is the mini NASDAQ. Where is my micro NASDAQ gone? What the heck? Oh, that's the mini NASDAQ because we went to the range bar 12. I didn't have the micro NASDAQ. So that was a big loss we just took. $70. See that? If we'd have been in the micro NASDAQs, 10 times smaller, it'd have been $7. That was no good. We're getting chop, chop, chop. Look, what is this? We got a nice smooth up and we're getting lots of chop down. That's bullish. That means we're probably going to get a nice smooth up again. When are you going to take it, Land? When are you going to take it? Well, let's wait for it to start going up first, see if it's going to do that. Usually that's what happens, right? Smooth, choppy, 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 smooth. And the second smooth, this smooth is usually bigger than this one. So we got a big move coming ahead of us to the upside. That's what I think. So it's happened in the past. Past performance is not necessarily indicative of future results, but If you've seen it in the past, that might be what's going to happen in the future. We want to try and take the reversal? No, let's not take the reversal. Let's do what we advertised we were going to do on their little front marquee. We're going to take the ABC pattern. What's the ABC pattern, man? Isn't that an ABC pattern right there? You got your 5 little bars, you got your pullback. Now you're looking for your rally. I guess you could say that. So if it breaks and starts to rally up, we could go long. But if it breaks below this low, then we're no longer in ABC up, we're in an ABC down. Right? It's got to stay above that. Let's bring this full screen. Are we going to trade the NASDAQ, land? We rarely trade the NASDAQ. I know, because it's a big market. Oh, there it goes. See if it'll go. Oh, land. They got you. Boy, they got you on that one. They tricked you. Yeah, they did. They tricked you on that one. You thought that thing was going to go to the moon, but it didn't. Here comes the Wyckoff spring right here. This is the head and shoulders. Boom, boom. Here we come down. We'll come up, and then we'll go. Is that what's going to happen? If it doesn't, if it comes down and makes a new low, a new head, we'll have to adjust the whole thing. This thing comes down here, we'll have to move the whole thing down like that. So for now, we're going to hold it here. Ooh, it's dropping farther than I thought it would. Now it's breaking below this point here. Where's your ABC land? Well, it kind of died on us, didn't it? Yeah, we got to redraw that. Oh, you. Look at this. You tried to go long on a short move. Well, that happens sometimes too. I thought it was going to turn and go back up. I was wrong. How much was that? From there to there, that was $500. Is it going to come back up now? Possibly. Let's wait for our ABC pattern. ABC. Let's get a little pullback, and then we'll try and take it. But what if it's just one of these, land? What if it's ABC on the way down? ABC down. Now it's going to keep going down. Well, it could do that too. That's why we do that reversal thing that we always get our heinies handed to us with. Okay, are we going to get our ABC? Come on, pull back. There's a little pullback right in there. Ah, you rotten market. It's not going to participate with my directional trades, is it? Why don't you just trail there and take a reversal, land? You'd have been smart. But now you're dumb. I know. I'm always dumb. Now watch it die. Won't trade anymore. Why? Because you're trading it. Okay, there's our little ABC. That's our little pattern we're looking for, right? Greens with a little red pullback, and then we're looking for the next leg up. That's your ABC. No, don't die on us. It died on us. You worthless little pig. What are you doing there, land? Well, I'm using this little OCO 4 right here to try and capture whichever direction it wants to go, which in this case is nowheresville. And I'm just putting a one price bar back with a reversal order on there. We're not going to double up like we did 2 days ago where we got our heinies handed to us. But we're getting our heinies handed to us here again because the market's just not doing anything. Come on, you rotten pig. Okay, are we going to get another down? Keep going. No, I don't want to. So easy, isn't it? It looks so easy in hindsight. Take it, Landon. You're up $130. Just take it right there. Take it. I'm only in with one. I want to see if it'll go farther than that. Just take it, Land. You're up $190. You're up $200, Land. Just take it. It's breaking across the previous high. Just take it. Just take it, Land. It's not going to go any higher. It's going to come down. Just take it. Just take it. Just take it, Land. Just take it. Why don't you just take your money when you got it? You're always trying to go for such long trends. Why don't you just take the money when you got it? Because I'm trying to be a day trader. I'm not trying to be a scalper. I just want to get to break even and let the market run. But you're right so many times, and then you just don't take your profits. I know. Trying not to be a scalper. Trying to be a, well, why don't you do your scalp and trail strategy then? At least take some off once, and then you can let your trailer go. Okay. I'll try that. Why are we trading the NASDAQ anyway? Rotten little market. This is the only one moving. Okay, we'll do scalp and trail then. Scalp and trail in this big market's scary. You need a lot more trades, lot bigger size. Yeah, but maybe you could scalp somehow. Maybe you could get a little. You could take like $100 if it hits $100. Then you, oh my hell, look what's happening to us. Maybe these range bar 12s are even too small on this size market. Lan, are you really down $700 right now? I am, because I'm trading the mini NASDAQ. The market's big. But if it would move, it doesn't have to move very far. We can make that back. If we could just get one trend, one good trend. There you go, Lan. Look at that. You're making some money. Take it, Lan. Take it. All right. We broke above the previous high. Where are you going to take it? Watch the little tiny chart in the upper right-hand corner. We'll take one off. All right. We scalped. Now we're going to edit. We're going to come in here and bring this down. Now we're only long one. That was our scalp and trail. So we scalped out $100. Or I guess that was $200. Take the other one. Take the other one before it comes back, Lan. Take the other one. Take the other one. Well, what do we have a stop for if we're not going to use it? Aren't you going to use a trailing stop and let the market see how far it wants to go? Are you going to do your trail? Are you going to do your scalp and scalp? Or are you going to do a scalp and trail? We could do a scalp and scalp and take off that other $150 right now. But that's not a scalp and trail. That's a scalp and scalp. Are you a scalper or are you a trailer? Sometimes that market goes to the moon. Yeah, but it's not going to the moon right now. So just scalp and scalp. You do you. I'll do me. I got to teach you something. I want to teach you about the spider web. What's the spider web, Lan? Oh, what the heck was that? It's supposed to be our reversal. Now we're not in the market. Damn it. Boy, this thing's going fast. Good thing we're in the demo account. What, Lan? You're in the demo account this whole time? I thought you were trading real money. No, we don't trade real money in a classroom environment. A lot of what we do here is learn what not to do. Right, guys? I mean, we try a lot of things in this class. We learn what not to do a lot of times. A lot of times we learn what not to do. Still learning. Might as well do it together because I know you want to do this kind of trading. And so we might as well do it together and see what happens when you do. It's fun, but you're not going to do it with real money. Am I right? Probably not. I mean, if we could get it to If we could find a combination that worked every time, right? It'd give us, I mean, this works. This works every time if the market will run and trend. If the market's dead, it won't, you can't make anything work. Nothing works. So the real name of the game of trading is really, really, really easy if the market is trending. When a market is not trending is when it's not easy. This is really hard to trade. It's not going anywhere. How can you make money if a market won't move? You can't. So as traders, what we have to learn is when to trade, not how to trade. How to trade is easy. When it crosses that little thing and goes, that's when you trade. You didn't trade there, Len. I know. Hindsight's 2020. But the point is, you're trying to catch a trend, right? If the market's trending, so you got to know when markets are going to trend. And that's the hardest thing to identify. You don't know when markets are going to trend. So we kind of use top of hour. We know that markets have a tendency to trade at top of hour, and we've talked about that a lot. And so it's a nice time to try and get into some positions. You take 2 or 3 shots at it, and if it doesn't work, you stop and come back at a different time when you think the market's going to trade. Our job as traders, executing an entry or executing an exit is way too easy. It's a click of a mouse. How hard is that? That's not hard. Okay. The hard part of trading is knowing when to click the mouse. That's the hard part. Just figuring out when you're going to click the mouse. Now, we talk about all kinds of different ways to do it, ways to filter, right? First thing in the morning, the markets generally trend quite well, so you can usually get some trends out of it. It's not right now. It's not going anywhere. It's dead. So you keep trying to go back and forth. There's no money to be had. There's nothing in there. It's not moving. And this is a big market. So if you try 3, 4, 5 times, get stopped out, have 2 or 3 entries, nothing ever pans out for you, you can't make money. How do you make money? So what we do is we use indicators oftentimes, and that's why I keep telling you guys, only buy when you're way down in the lower regions, or only sell when this thing's way up in the upper regions. And these aren't even way up in the upper regions. It's kind of just tagging along through here. Here was a good spot, and it proved out. Okay. This one here kind of corresponded. This one didn't. Look at that. It wasn't even up in the higher region, but that kind of sucked. We're short. How come we're short right there? Did we get turned around and again we got, oh my gosh, Lan, you weren't paying attention again, and look what happened. Now there goes the run. We got stopped out on that one little pullback right there, one little price bar. So range bar 12. We tried range bar 6 last time. It was too fast too. I think range bar 12 is too fast on this market. Let's go try a range bar on a 12 on a different market. How would we have fared here? Not any better. This market died too, didn't it? But it's slowed way down. It's not going nearly as fast as that NASDAQ. So we slowed down the price bars from yesterday. Yesterday we're doing this on range bar 6. Today we're doing it on range bar 12. And then we went to a faster market. Well, that didn't solve the problem for what we were trying to do yesterday, right? You don't go to a faster market and slow down if you would have tried to do this yesterday, NASDAQ on range bar 6, that would have been pretty nasty. So we slowed down the Russell. Still pretty fast. Look how fast that thing's moving right now. But it's half because we were at 6. Now we're at 12. So we slow this one down a little bit. We'll see what happens here. We'll try this on the Russell with a range bar 12. Now it's not nearly as big a market as the other one, so we don't make as much, we don't lose as much. We're on the back side of the MACD. So the front side of the MACD was over here. You rotten dog. You don't want to go anywhere either, do you, today? Go, baby, go. Is this an ABC up, ABC up, or is it an ABC down? Don't know. It's called a decision point. You have to decide which one it's going to do. Well, we're reversing, so we're doing both. But we're not reversing and increasing, so at least we're not doing that. And these are Heikin-Ashi bars. That's the other thing that I didn't say. You rotten machine. Just take the arrows, Lan. I am. I'm just taking the arrows. Just trade the arrows, Lan. How many times have we said that? Just trade the arrows, Lan. That's what I'm doing. I'm just trading the arrows. Yesterday, you know what I did? I turned on the autopilot and told it to scalp. Just scalp. No trail. Just scalp. I actually did pretty well. Maybe we can turn that on here in a minute. Of course, that's not, I mean, just watching the autopilot trade, I guess that's fun. Ooh, I don't think we're going to ever recover this amount of money again. We're going to have another one of those days. Very first day, January, February, March. This is the first day of March, and Len's going to have to dig himself out of a hole the rest of the month. Trying to get this back. What's that setting you keep using? It's this QOCO4. I got it set scene number 1, so I'll show you what that is. It's just a auto trailing stop on the ATR. That's all it is. And then I set it to where I want it. If the ATR dot hasn't flipped yet, I set it to where I want it. Now, the whole idea of this is we do this on every single arrow, which hopefully you guys aren't doing. Just trade the arrows, man. Just trade the arrows. I hope you're being a little bit more judicious about taking the arrows. But this is the setting that I have it set to do that. So this one's on the ATR, and sometimes we use this one here, which is the number 1, which is the exact same thing, only it's on price bars back. So what it does is it doesn't attach the OCO orders to it because we're sitting here. So I just want it to do the auto trailing stuff for me, so I don't have to manage it and trail it and move it by myself. Each time the market moves, it moves along those yellow dots. So now what I do is I come and I drop that in there and say, okay, if it goes back up and doesn't continue to fall, break through those yellow dots, then it'll reverse and go the other way. We're just doing 2, 2, 2, 2, 2, just to see if we can't catch a trend, right? We haven't been able to catch a trend. The market's not trending. It's not doing anything. So again, our job as traders is to determine when to trade and not just try to take every single arrow. Take every single arrow, Land. Take every single arrow. So we got a little filter on this one. See the blue filter? The blue filter says you should only take down arrows after the blue filter. So don't take this one here. That's the idea, right, of having the filter. So this one here says only take the long arrows. So only take that one, only take that one. It didn't take this one because it was still in the blue filter to the upside. I'm just taking everything, every reversal. I'm just taking every single reversal. So we're going to take this, we drop it in here, 1 price bar back, and we hold it there. And if it doesn't break through see, it's trailing on those yellow dots. So every time it crosses the yellow dots, which is the average true range, and I got to set really aggressive. I got it at 0.7. Let's bring that up to 0.1. Well, that might help a little. I had those really aggressive, didn't I? There's a lesson for you. Always make sure your indicator is what you think it is. Okay, and then the trailing stop is just trailing on those yellow dots, just trying to trail up on the yellow dots. You had some money, Land. Why didn't you take it? That was your scalp. Guess we could. Maybe it wants to go. Come on, buddy. Be our friend today. You don't have to wait for it to come back and stop you out. I mean, if it comes back to break even, you can just get out. I take more losses because I'm letting it go all the way to the stop. Maybe that's a good lesson for us too. But that means just bring it to break even faster. And if we're going to do that, then why are we trailing on the yellow dots? Well, if you wanted to do that, Len, how would you do that? How would you set that up so it just comes to break even faster? So if it doesn't move even more dramatically in your favor, how would you do that? Well, we could set it up in the OCO to do that. I'll show you. It ain't going. Okay, we could come in here and we say add a new one. And we'll call this number 1-1 because it's going to be the same thing. All we're going to do is just make it go a little faster. Okay, so we're going to go trail faster. Call it whatever you want. We're going to call it a stop. Stop trail faster. Make this our primary. Hold on a second. I got to drink some tea. So now what we'll do is we'll come in and we'll say, okay, we're going to put this as a stop, and we're going to make these again. We're going to not put our stops and limits on there, our OCOs. And we're going to trail, and this time we're going to trail ticks behind. And we'll trail, what did we say 10 ticks on this thing was? We'll start with 10 ticks. Let's try that. So we'll trail 10 ticks, and you can't do break even unless you do an OCO. See, this is your regular entry. Oh, this is for your entry, and we don't have OCOs. How's that going to work? We'd have to do something different. We couldn't do that. If we did this, watch what happens. We come in here and we drop that one in there. It's going to trail behind the market 10 ticks behind. It's just going to trail 10 ticks back. So we probably put that on the wrong. Because if, let's say we get in with 1, so we go in like this, and we're trailing on the ATR for entry. That's what we'd have to do, huh? Let's come put that over here. So we'll add new OCO, and we'll go number 1-1. And we're going to go trail ticks back. We're going to start with 10. And we're not going to have any of these, 0. And we're going to make this one 0. And we'll make this our default, and we'll make this a stop. And then we'll tell it that we're going to trail ticks back, and we're going to do 10. So that's that one. Right? Now we can put this one back to 1 here. Now what happens is if we get into the market, okay, let's say we get into the market. So we get into the market, let's get in with 3 contracts. And then we're going to just trail 10 ticks back. Now the problem with that is it's not going to just trail to break even. It's going to trail, it's just going to keep trailing 10 ticks back. We want it to stop at break even. So the only way we can do that is if we set the whole thing all at once. So that way we would have to set up if we're going to do a market order, we don't want to do market order though. We want to do trail to entry. So let's reset this 1-1 up again to do this. We're going to do trail to entry, and we're going to trail on the ATR for entry. And then we're going to put a stop at 10, and we're going to put our limit at, well, 20 would be a risk 1 to 2. Okay, we'll do that. And then we're going to trail the ATR for entry, but then we're going to have we're not going to jump stop it. We're going to just trail the stop ticks behind, and we're going to put it 10. And then we're going to say trail till break even. How's that sound, guys? Oh, I'm not paying attention. Okay, so now, well, that didn't work. What did I do wrong? Did I get, I didn't hit save because saw the market start to go without us and we were in the wrong side. Stop. And we said, stop 10, 20, ticks behind, 10, trail, ATR. Oh no, we said we were going to trail ATR for entry. We're going to trail ATR for entry and we're going to trail ticks back for exit. 10 ticks back and we'll trail until break even. How's that? Does that look fun? Yeah, let's try that. So now what this is going to do is going to trail on the ATR for entry. That's going to be too slow. And I don't think if we go over to our faster market, that's this one. Get more action over here. Where's our 1-to-1 again? We're not going to be able to do it like that. That's too big. Let's start with 20 and 40. Okay. So, and what I got this set really aggressive. Let's go 1-to-1. Okay. Now that's going to jump to 10 and stop you right out. Well, good, it stopped us out, I guess. Mark's going the wrong way. 10 is still too. Oh, wait a second. I thought I did 20. I did do 20. That's still too big. Let's go 30. So go 30 and 60. Man, it's going without you. Where's your 30 and 60? Well, we just set it up to trail. We can set it up on the buy market, sell market to do the same thing. So you can just go boom, and it would set it all up and trail into break even, and then set your 2-to-1 risk reward ratio. You want to take the time to do that? I think it's a good idea, Lan. Okay, let's do it then. Okay, we're going to add one on the buy market side. So now this is just going to be we're going to still call it our number 1-1 strategy, and we're going to call it a market entry. Market. And we're going to do, what did we decide we were going to do? We say 30 and 60, right? 30 stop. 60 limit. 1-to-1, 30 stop, 60 limit. And then we're going to trail 30 ticks to break even. Right? So we'll make this our default. We're going to be a buy market. We're going to set this at 30 on the stop. We're going to set this at 60 on the long. And we're going to just to be a market, and we're going to trail, what do we say, ticks back. And we're going to set that ticks back to be 30. And we're going to trail it to break even. How's that? All right. So now if you come in and hit a buy market, boom. Now that's going to go, oh, look, but the ATR is closer. In this case, the ATR is closer. So you're actually taking a bigger loss than what the ATR would be if you were wrong. So let's come in and modify that. Modify our 1-to-1, and that 30 is too big. So stop. We're going to put that at, let's try back at 20 again. 20 seemed too small before. Okay, so that's trailed to break even. We got our limit up there. The thing is, if it trailed the ATR, it would trail the ATR, and the ATR would keep trailing up. And this is trailed to break even. So now if it comes back, it's not trailing. We could come in and tell it. We could say, well, I want you to trail the ATR after all. But that takes time. You can't take time. That's why I do the ATR. Let's try it again. So, okay, so it's trailing ticks back this time, not ATR. The thing is, if it takes off and starts to run, we don't have the sell stop, so we haven't set that one up yet. So we have to do that one. So we're going to add OCO, and this is going to still be the number 1-1, and this is going to be a sell market. 20 stop, 60 limit, and we're going to trail 20 ticks to break even. I guess we don't have to say the 20 ticks. That's redundant. One trail to break even. So our stop, make this our default. So our stop is going to be at 20. Our limit is going to be at 60. And we're going to trail bulls and bears blue light. No, we're going to trail. We said ticks back. And we're going to ticks behind. And we said we're going to trail at 20 because that's where we're dropping our stop. But that's when we might want to just try the ATR again. But we'll start like this. Did I do it right? This I didn't say sells. This was a buy sell. 1-1. This is a buy market. And we don't need to say trail 30. That's redundant. Just say trail to break even. 20, 60. Well, if we go 20, we don't need 60. We go 40 to do our 2-to-1 risk reward ratio. Ticks behind, we're going to trail 20. Ticks behind. So we do the same thing on this one. 20, 20, 60. No, we need that to be 40. 40. Ticks behind 20. Okay, trail to break even. Okay, so now we can just click the button. Oh, I clicked. Oh, wait a second. I have that set wrong. Exit chart. This is a sell market. Okay. Okay, try it. There we go. Now it's going to trail 20 ticks behind, and we have our 40 limit. Okay, so now it wants to go up. We'll just, this doesn't want to go up. It's going to turn and go back down again. See, but it's not dropping to the yellow dots. It's doing ticks back. So the yellow dots, I wonder if the yellow dots wouldn't be better. Well, we're already to break even at this point. I don't know. It's not better or worse. It's just different. It's not better or worse. It's just different. We're at break even, whereas the yellow dots would not be. And that was the goal, right? We were thinking the yellow dots came in too slow. So there we got one scalp out of it. That was a little flag formation that we got in on that thing right there. There's another one right there. So when it comes back and you're in a downtrend and it spikes, we get those little spikes in there where it spikes us out. Those are actually, on an advanced trading strategy, those are entry points. But they're dangerous, just like everything, I guess. So now if we want to trail, now that's trailing the ATR. Where's our one that trails just ticks back? No, that one's not set up for it either. Now we don't have anything to trail for a reversal. So we're going to come back. That's going to go to 1. That's our trail to reversal, but that doesn't have our settings. And we don't have our limit and our trailing stop. So how would you set that up, Lan? Let's do that one. We'll come in here. What's our number? We're on a 12. Let's do number 13. Lucky number 13. So number 13, we're going to come in here, and this is going to be a stop, and it's going to trail. And now what are we going to have it trail? Trail 1 price bar back, 1.1 price bars back. And then we're going to have a 20 on the stop, and we're going to put a 40 on the limit. And then we're going to trail to break even. How's that sound? Oh, man, you're getting your hiney handed to us. You're not paying. Oh, and I just missed all my settings. Doggone it. Don't sit there and try and do 2 things at once. You're not good at it. Add. Now I got to put it all back in there again. Number 13. And what did we decide this was going to be? This is going to be a stop, trail, 1.1, price bars back. And we're going to do 20 on the stop. And we're going to do 40 on the limit. And we're going to go trail, price bars back. Price bars back. Stop, trail, 1 price bar back. 20 stop, 40 limit. So we got to make this our default. There's going to be a stop. We're going to stop at 20. We're going to do limit at 40. We're going to trail for entry, 1 price bar back, 1.1. And we're going to trail for exit. What did we say? We're just going to do ticks back, right? 20. And we're going to trail till break even, or should we continue? We'll just trail to break even. Okay, so that's setup number 13. All right, so now this would trail 1 price bar back. So that's going to, how come it's not doing it? What did I do wrong? Oh, I didn't set it as my default. 13. Where'd my 13 go? What the heck? Where is it gone? Where did I put 13? Oh, there it is. I used the wrong button. I don't think I want it there. Is that going to keep going up? Nope. You didn't reverse land. Oh. Okay, let's try it. So we're trailing 1. See, now look at the yellow dot. Now we're closer. We're closer than the yellow dot. Whereas if we did the yellow dot, we'd be clear back here. So that was the idea, right? We want to get in, not risk so much to the yellow dot. Okay, so it's moving down. It's to break even. And the yellow dot is at break even now too. So that one. But trail to entry, that would be the trail to entry. So as it makes a first candle to make a new high, stops this at 20. Anticipate a continuation. It's going to move up as the market moves up. There it goes, all the way to break even. Take one off, land. Take one off. This is the counter trend, isn't it? Because we got drive. We got all these drives. Drive 1, drive 2, drive 3. This is just another counter trend. Little counter trend, little counter trend, little counter trend. So we could actually trail. We could pop it in there again and trail for a reversal. What did that do? Oh, it got us out of the market. That didn't work. 13, trail. Okay, so now it's going to drop down, 20 ticks back. Yeah, it's going the other way. There's no yellow dots. We got the same thing on the buy. So we hit the buy button and we got the same thing. So now we got the buy button set and this should trail 20 ticks back to break even. Okay, just to let you guys know, this is not how you trade. This is how you figure out new settings in your software. That's why we have a demo account. So we can try this stuff, see what it does, practice with it, write stuff in there. You guys doing this? I hope you're doing this kind of stuff too. Just because I do something in my class, do ATRs or do something, and we get myopically stuck on doing one thing. We don't experiment with new stuff. So this is called experimentation. Let's come in and we'll experiment, see whether we like something better. Now the yellow dot on that case would have been the exact same. Now the yellow dot would continue to trail. We could do that, edit. Hate that. Trail ATR, but we hit our limit order, so we're out. All right, we're getting these things all jumbled around. We got to have a trail, one price bar. Oh, I can't. Oh, that's okay. See if it gets to catch the reversal. Can we reverse it going both directions? This way. That would just take us out. That wouldn't. I'd need a higher quantity. Don't want to do that. We have to go 5, 6. Would we want to try and reverse like that? I don't know if we would. So that trailing is trailing one price bar back for entry and then has our 20 stop. And it's trailing where the yellow dot would not. Just doing ticks back. Now we're at break even. We could continue to trail. The problem is if you continue to trail, we got stopped out of break even. How would you capture that? Well, you'd have to continue to trail. Problem is if you continue to trail after you get to break even, after you get to break even, oh, you're not doing anything to play with us. Come on. So once it gets to break even, how do you capture it? You'd want it to continue, but you want one to continue and you want one to stay at break even. You'd have to enter 2. You'd have to have 2 positions. You'd have to set it up. Boy, you keep getting spiked out. There's no volume. Look, the volume's like 20. We're just trading on too small of a time frame. These markets are just, look at this. The market makers are going between here and here. And they just go back and forth between here and here. These are just market makers, just whipping the market back and forth. Okay, so that trails. This market's not doing anything. It's trying to catch a trend. But we're not. We're just trying to scalp, aren't we? But this market's not doing anything. The market makers are in control. Look at all these little market maker moves. These are just market maker moves. They're just killing everybody, just wiping everybody out. You could slow everything down, go back out to the 1 minute chart, and then you look at that and you're like, oh, why didn't we trade 1 minute charts, Lan? Because we were trading tiny charts. You want to go down to a 20-second chart, right? That's what happens when you go down to a 20-second chart. Those were even faster than 20 seconds. Those were going 10-second charts. But could you do the same thing here? You could, but you're not going to be able to do 20 ticks. We set it all up for 10 and 20 ticks. What would happen if you drop that here? See, it'd be way too small. You're still trading down inside that, which is why we go back to, see, that's what brings us back to our number one, and just do the oh, that one was, and do the ATR. See, that's why we trade these size charts. Now you know. Now you know. I guess we learned something today, right? You get down too small, it doesn't do you any good. So if the market's too big and you can't risk one price bar back on the minis, then you try to go down to those little itty bitty tiny 20-second, 15-second, 5-second time frame charts. Market's just too small. That's where the market makers are in control, and then they just keep spiking you out back and forth. Doesn't do us any good. So you got to take a bigger risk. That's all it's saying. Take a bigger risk. Not try to trade those little itty bitty tiny moves. Even 1 minute chart sometimes seems too small, but that's why I have in here 2 minute charts, because I like 2 minute charts too. The 2 minute charts, you can see this market's not doing any. Oh, this is the S&P. Go back to the NASDAQ 2 minute chart. There it is. Oh, we were on the Dow 2 minute. Dow, that's the one. That's a 2 minute chart on the Dow. See, it never did break the, still in the uptrend. But then you're like, well, that risk is too big. How big is it? Well, from where it's trading to the stop, that's $130. I don't want to risk $130 every time I get in. That's the problem with going down smaller and smaller. We keep going down to little tinier time frames, so we don't take big risks on the entry, but then the market just gets whipsawed too bad. What about a range bar 25 lay-in? Okay. There's range bar 25. Go to the ATR. Let's change that up a little bit. Go back to 1 so it's not quite so aggressive. Let's take this off for a second. That's why you have these different, did you see that? Chart overlay, bulls and bears, blue light. That's why the bulls and bears pulls the dots farther away, so you don't keep getting stopped out. Still comes in. Look at that. See, when you get a decent trend, the bulls and bears blue light's designed to come in basically the same place as the ATR. Look at that. See, same place. Not quite the same place, but almost the same place. Not quite the same place. This market wasn't long enough. But if it's long enough, look at that. The blue lights and the green lights came in at the same spot. Here again, blue lights and green lights came in at the same spot. Not quite so much here, not quite so much here, because the trend was worse. But once you get a decent trend, they kind of come in at the same spot. The difference is that look at how many times the green dots on that lousy little trend got spiked out. Probably got spiked out here, probably got spiked out there, got spiked out here. But yet the blue light didn't get spiked out at all, and it still closed at the same spot. Now here, the market went a little more aggressive. The green one would have been better than the blue one. So it's like I always say, which is better, Land? Well, it's not better or worse. It's just different. So you could trade but if I did that, you guys are going to freak out, right? If I come in here and said, all right, I'm going to get in long here, looking for this thing, I guess. We'll just make up a reason to get in. So we're going to get in long here on a break above this previous high, anticipate a continuation of the uptrend, but I'm going to put my stop on the blue light. Look how far back it is. If I drop that thing down there, so I drop a stop down here. Let's do it like this. We'll go buy market, and we'll add our OCO. Add OCO. Well, they're at the same spot now. Edit, and we drop this thing on the blue light, trail on the blue light. That's how far back we are. I don't want to be that far back. Get it closer. Get it closer. I don't want to take that big a risk. Okay, go down to a smaller. I don't know what to tell you. That's the problem that we have, right? That's trading. You got all these different dilemmas. The green dot would have got stopped out on that trend right there. Would have got stopped out probably 1, 2, 3, 4, 5, 6 times. Blue light didn't get stopped out at all, and they ended at the same spot. But then in this situation, you get in, and then it starts to go up. And if you'd have stayed in with the blue light, you'd have got stopped out. $100 bigger loss than the green light. So what do you do? That's why I do what I call the cat's meow. When we get a little bit more sophisticated, we put stops on both. So we trade multiple contracts, right? So we're in with 3, so we get rid of this, and we come in here and we'll put 1 stop, and we'll drop 1 on the, and we'll trail on the ATR, and chart overlay, we'll go with parabolic SAR, and then we'll go stop, and we drop 1 on the blue lights, trail on the blue light, bulls and bears blue light, and then we throw stop 1, and we're going to drop it, stop 1, and we're going to drop it, edit on the parabolic SAR. So you got 3 different, that one's not there yet, so it won't trail. So we'll have to put that one on. For now, we'll put it on the more aggressive one. Yes, ATR. Okay. So now if that market continues to rally, you got 3 stops. 2 of them are on the blue light right now. 2 of them are on the green light. One's on the blue light. So it'd have to break those red lights before we get a new ATR, a new parabolic SAR, and then we could put on the PSAR too. So see, they all end up basically at the same spots. It's just how far back are they going to hold? See that? So you got the green dots, they hold your stops the tightest. So you take the biggest loss if you get stopped out. But you also get stopped out prematurely a lot because you're holding your stops so tight. Then you got the parabolic SAR, which is kind of, I got it set to be kind of the halfway in between. So it's the halfway in between one. And then you got the one that's the blue light, which lags a little bit further. It's a little bit slower. That's the one we count the Elliott waves with. That's the way it's tuned in for counting Elliott waves. But see, we got long here, trying to go long. Now it's coming back. We got stopped out on the green, but now the blue is going to take a bigger loss. Not much bigger, but bigger. See that? It's all just, what are you going to do? What are you going to do? I don't know the right answer. I'm just telling you all the answers, and you can make up your own mind. So now we got a little, that's why I use the ATR. I just like the ATR a lot. You see me use the ATR a lot. So we're coming back to make ourselves a bow tie. Is that going to come all the way back down to the full bow tie? Probably where we'll see it come down to. Fibonacci ruler land. Fibonacci ruler. I thought you were going to teach us this. I thought you were going to teach us the spider web. Well, let's do that then. Okay, what's the spider web? The spider web is in between these pullbacks, like that. Let's get rid of some of these dots so we're not quite so. Okay, I'm going to get rid of this ATR one. The spider web, I generally do it with the bulls and bears. All right, so here's the spider web. What you have is you have a market and you're anticipating that ABC pattern, right? So ABC. Well, at this point, we don't know where the market's at. So it's like right down in here. So let's bring it back to here. You guys don't have this feature. This is an educational feature for me. Okay, so I can bring the charts back in time. Maybe I can if I can figure it out. There we go. All right, so as this market comes down, right, breaks the blue lights. So now we are labeling, right? So this is where you label. So we're going to come in here and we're going to label this just to be, this is your A1. This is your B1. So this is A1 right here, crossover. This is your B1 down in here. That means we're coming in and we're breaking those blue lights. That means we're anticipating a C1 right here, right? So if this is C1, then we're going to use the spider web. Now this is the spider web tool right here. See it? It's called trend fan. So you come in here and you draw it from the peak and you just draw it across the tops of those trends. That's your first line. And then your second one is somewhere halfway in between. And then your third one, actually, it's going to be on the blue light, but this is going to be over here on the, like this, which is tied off at the horizontal. Okay, so let's get rid of this. So now you're anticipating on the C drive, you're anticipating this is an X3 right here. X2 actually, right? X2. So this is your X2. So we hit the X2. And now, if the market's going to move forward, okay, we got another little pop up. We're waiting for it to It's breaking that natural trend line. It's ugly, but it's breaking the natural trend line. So I would put this one here on the blue lights, and this would be your natural trend line break right there. Okay, so you're going to take your C, and it's going to come up here, and you're going to do it. Oh, come on, too many tools. So there we go. So there's your natural trend line. The second one is your mathematical trend line, and your third one is your break above a previous high. So take that tool, and you go from here down the natural trend line, the blue one, and then the horizontal. Okay, and we do it again here, down the natural trend line, and that natural trend line is the same as the mathematical trend line. So there's your natural trend line, there's your mathematical trend line, and then you got your horizontal up here. Now the idea is that you want to be getting in on these breaks of these natural trend lines and where the blue light comes in. And if they'll match up like that, that's generally a pretty good place. You like to see those things come in the natural trend line. You like to see the natural trend line and the blue lights match up as close as possible. Okay, so like that one there, that was a good one. And then you're supposed to trail up on the blue lights till exit. I like to try and get out and be taking profits by the time the market hits this previous high, this horizontal line. So that's my profit zone, is the break here to here. A lot of guys get in right there, right? A lot of guys get in on a break above a previous high. I'm not saying it's a bad thing. It's just I like to be taking profits by the time other guys are starting to get in. And then you can try and get in and ride it up again if you think that thing's going to make a full bow tie. But half the time we don't get full bow ties, right? We get things that look like this. We get a pull back, a rally up, and you think you're going to get your bow tie right here, and it doesn't. So there's your tie off, break above the previous high, and then you think you're going to get a full extension for the bow tie, like here, back to here, to get that bow tie, right? But that oftentimes doesn't happen. What happens is we get these little tiny bow ties, these little tiny ones, because they're weak, and they come in like that. And so we end up getting stupid little bow ties like that. And that's what that is. That's a stupid little bow tie that didn't fulfill our wants and desires. The whole idea is that this leg here is supposed to be the same distance as this leg here. So this leg here should be the same distance as this leg here. And in this case, it was, but it broke above the previous high, and it didn't go to the second extension. Okay. So you get 3 drives: drive 1, drive 2, drive 3, drive 1, drive 2, drive 3. But they just didn't extend as far. So the markets are not having a lot of strength. And that's what we've been seeing a lot of lately. We're supposed to get nice big bow ties that look like this, equal size above and below the previous high. That's why guys have been trained and been to buy on a break above a previous high, because that's usually a good spot to see these markets take off and go and break up and make that nice big profit. But we've been getting a lot of these types of bow ties lately. This is all the markets have been doing for us. Doesn't matter the time frame. That's what the stupid little things don't work. So these little stupid triangles, that's not big enough to make any money. You can't get in right here and make any money on that. So that's why I always say, get in down here. Try and get in down here. That's what that speed fan, that trend line, that I call it the spider webs for. Get in down here, get out up here. All right. So you got 2 entries. You got your natural trend line break. You got your mathematical model trend line break, which is right there. And then this is your breaking above the previous high, which is where you want to be taking profits. Or if you're in with multiple contracts, take your profits as it reaches up into there, and then let the others ride to see if that won't break out and give you a halfway decent Fibonacci bow tie. So in this case, see, we got our trend line here. You can get in there, anticipate your stop would go behind here like this. And then as the market comes up, breaks a crossover at the same spot as those blue lights, that's your next speed fan. And then you want to see that thing continue up and break above the previous high. But again, right there, your distance for profit is that's it. So that's not a good trade. Not a very good position to be in. You don't want to be getting in here and having your profit zone right there. Right? Now this one there came up, tested the high right there. So you could get in on that blue light in anticipation of a continuation, but hopefully you were in a little bit earlier. Maybe down here. Oh, grabbed the wrong tool. Maybe down here. This is just a tough place. But this market then started to go. That's where it took off. So now it's making a little ABC. We thought, well, there we go. This is our A, B, C. This is almost a full reset, isn't it? Because if you take your Fibonacci ruler, let's get rid of all these drawings. Delete all the circles, delete all the trend lines, delete all these trend lines, delete all these trend lines. So if that's A down there, this is almost a full reset. When it goes back that far, if you take a Fibonacci ruler, and it came all the way back into the 78.6. I always say if it breaks out to the downside of the Fibonacci sweet spot, you almost want to start your ABC counts over again. See, I hate it when it does that. I call that a reset on your ABC. This is a 2-week to call it a full of 3 drive pattern. So when it does that, hindsight is always clear, right? But I would say, we can move these. This becomes your A1. This now becomes your B1 because of that big reset. And then this looks for a C1. Now, if you don't have to reset them. I mean, you just call this a D1, right? Which is really rare. So we'd have to move that too. So this is X1, X2. Technically speaking, if you're going to start your counts over for a new 3 drive pattern, you're going to have to start your exits over as well. So that's an X2. This is an X1. Like that. This is our speed fan up in here. Where's our speed fan? So this is our spider web. I had one spiky do, and that's look at that. See, that's not good. That blue light crossover is coming in at almost the same spot as the high. So that's not good. You don't want to take that blue light. You want to, at that point, you might as well just wait and see if it's going to break and hold above the 3rd drive, or in this case, the 4th drive, because this really looks like it's hard to decide whether you want to call that drive 1, drive 2, drive 3, and then this is a topping formation, an ABC top formation for the downside, like that. That's what I'd be more inclined to do at this point. But it's trying to have this full reset, drive 1, drive 2, and it's trying to have a 3rd drive right here. But those are your spider webs, and that's what I wanted to talk to you about today. So you draw your natural trend line, your blue light trend line, and your horizontal trend line. You didn't draw that very good, Lan. And then your horizontal. And that is in the manual. There's actually pages in the manual. If you go to the manual, what manual, Lan? My manual. I have a manual for the class. It's right there. Stock Market Playbook of Strategies. All this stuff is in the manual. You can go get it on Amazon. Just search Lan H. Turner, and there's a whole book on all this stuff. This is what I was having technical difficulties with this morning when we were first starting. Where's the spider web? I went too far. I think the spider web's closer to the front. See all this stuff? It's all in the manual. Tells you how all this stuff works. I don't know where is the, you can see the whole manual. Here's the whole manual. You can't find the spider web. Oh well, it's in there. Spider web's in there. Well, there it goes. It broke above. So now is it going to hold above? What is this? This is a range bar 25. This is a dangerous spot to be trying to take a long position because we're already at the top of a 3rd drive. We'd be looking for, wait till that thing tops out up there, and we look for the reversal. in anticipation of this thing turning and falling back down, right? I don't think we made any headway with our new QOCOs today. That didn't help us out much, did it? I think we learned some stuff though. We learned how to make some adjustments to your software and program in those QOCOs, and you can practice and try and figure out where you want to put how you can set up your settings a little bit better. I think that was a good example of how to use the OCOs. All right, guys, I guess we're wrapping it up here. Let me come and see who's all here. Still got a pretty good crew of people in the watching. I'm surprised I haven't had 1 million people leave by now. This has been a tough day. I ran the autopilot yesterday, I was telling you. Where's my autopilot? And I updated the spreadsheet. So this is the spreadsheet. How come I can't? I hate Microsoft sometimes. Come on, give me some arrows. Give me some control of this thing. Ding dongs. All right. So we'll go full screen, I guess. Okay, so yesterday we had a good day yesterday. So we had $409 in the morning. So we put that into our spreadsheet. And then I ran the autopilot. And during autopilot, I tried to work on autopilot strategy, picked up another $600. I set the autopilot strategy. I set up the autopilot. That's a long read. I set up the autopilot enter on the ATR with the simple moving average 3 and 50 as the long-term filter on range bar 6 charts with the Heikin-Ashi. So I documented the whole thing. I set the stop at different levels, different markets, trying to judge the loss match the ATR. Dots might land and start trailing than the limit order. Anyway, amazingly, I turned off the autopilot a couple minutes before the market. It's a good thing I did because the market went crazy. But the lesson here, my favorite time to turn that thing on, top of the hour, 9, 10, 11 a.m. Then again during power hour. Of course, I've had my best luck during these times, but I've also had bad luck. There's no one size fits all. Of course, I think it goes without saying. We also want to turn it on during news events, but for me, not nasty, big moving news events, more of the 2-star news events. It's an art, not a science. So again, I turned that on. Basically, that was the autopilot yesterday. I was playing with the autopilot, yesterday I was trying to sync in what we had done yesterday and automate it. So that's what I was doing, and those settings are in that drop down. You can go back and look at the video and put those into your own if you want, or you get this video, you'll get this spreadsheet for free when you go get your Pit News magazine today. It's been updated. It's out on the web. So when you go download your new Pit News magazine, you'll get an email that says Pit News magazine's ready. Go get it. And then you'll also have the link to this in the landing page. You'll have the link to this, or I'll send it in the email. I guess it's the landing page is only for new subscribers. I'll make sure you guys have links to this. So it's out on the web, and you can get this new spreadsheet. And I've already moved it over to March. All right. So this is our new March spreadsheet. And what did we get our Heine 3690? Are we really going to go in there and put 3690 as a loss? 3690. Oh my goodness. So that's our new spreadsheet. Okay, so there you can have the new spreadsheet with Pit News Magazine. If you have Pit News Magazine, get this new spreadsheet. I've already moved it over for you. And I've got all my new formulas and everything in there. That kind of makes that ugly spreadsheet. Again, that's more, we're doing the spreadsheet in the classes so you can learn how to do the spreadsheet. That's important too. That's an important part of trading, just to learn how to track your trades. So how to do that part of it. Okay, guys, I guess I'm running out of things to say. I've got nothing else to say. Let's see. Michael Bruce says that's a dangerous business. Oh, yeah. I think you're talking about Ross Cameron. You can't not know Ross. I mean, he's everywhere on the internet. He's one of the biggest dudes out there. So you're going to get to know Ross if you hang around on YouTube very much and look at trading stuff. John David Lumberg, 8 a.m., 3 news stars. Oh yeah, we didn't really go look at the news, did we, John? So John's making a point that we should have looked at the news, and we didn't do that. We got carried away. Michael Bruce, he's saying that dangerous and unpredictable. It is. It's a dangerous. David Duty likes to trade it because it's so wild and crazy. He waits for those perfect setups and then bam, he just takes them really fast, and he does pretty good with it. So, you know, if you just want to be a scalp and scalper, just scalp and scalp, just like David Duty does, where there's, you wait for these little setups. And you've seen it 100 times where we've been trading. And if we would have just scalped $50, $75 off with each one, we'd have been fine. We'd have been making money. But I always wait. I want to see if I can't catch a longer trend. And so sometimes because I keep trying to catch longer trends, that's where we lose money. But if you can do a combination scalp and trail, that's the better deal. But sometimes we can't, it's easier said than done, right, guys? But David Duty, he just does scalp. So he doesn't even do trail. He doesn't even try. He's just like, I give up on the scalp and trail land. I just do scalp. That's all I do. And I do it on the NASDAQ because the NASDAQ moves so fast. Once I get on it, I can have that scalp $75 and I'm done. So that's what I did is I set that all up in the autopilot, and I ran the autopilot yesterday just to scalp, no trail, and it just scalp, and that was it. So you could do that. That's what David Duty does. Oh, Michael Bruce says he caught the runner in the Dow. Nice. Sweet. So we got John David Lundberg said he's doing the same thing, waiting for it to come back to the sweet spot. Come down lower than expected. WC Randy saying, I haven't got wild and crazy and gone all nuts like that yet, Land, but I can certainly see how I could. Yeah, you certainly can. It's not hard to get this FOMO, weird, wild, crazy, wild hair. That's why it's better if, the name of the game is to just really be very careful and watch for these 3-drive patterns and then look for these extremes. Watch for the extremes and then only trade during the extremes. That's what I do. When I'm trading real money, I mean, I'm going wild and crazy here, but when I'm trading real money, I'm really cautious. I'm just Mr. Super cautious. I've tried trading like this with real money before. I traded the Brexit when Brexit. Oh my hell. I traded like that during Brexit. It was crazy. I used to be a wild and crazy man. I'm not like that anymore. I'm really super cautious when I'm with real money. I'm so careful because I've had my hiney handed to me enough times. So I wait until everything. I miss a lot of trades that I feel bad about because I'm so careful. But at least my account stays green. It might not be huge greens and like it was before when I was a wild trader. Things would go. I mean, I would be crazy. I would have $8,000 days up, and then I'd have $8,000 day the next day down, and then $10,000 up, and then a $6,000 down, and it just rips you apart. It's hard to do. So I don't do that anymore. You blew up too many accounts. So you just, you got to be careful and just be really cautious and only trade it very carefully. And once or twice, just realize this is the NBA, man. And I'm a high school basketball player playing in the NBA. And if I can make a basket or two, I'm really happy. So that's kind of my mindset nowadays. I'm getting a little older and long in the tooth, and I'm a little bit more careful and cautious. So Kirk says he thought that we learned something there with the OCO lessons. So that's nice. Be able to go through some of the more advanced strategies and the features in the software. I think we do need to review them a little bit more like that. So hopefully that was helpful. So useful class. Good. Glad it was helpful. How do you reset your demo? Asking for a friend. That's funny. How do you reset your blow up if you blow up your account? You just send an email into the brokerage firm just send it into the boys at Gecko Software. They can reset they'll give you all the money you want. They'll reset it. You can tell them what you want to set it back to. Just send it in an email and say, I want it to be $10,000. I want it to be $5,000, and they'll set it for you. They don't care. They do it all the time. They don't think twice about it. That's what demo account's for. All right. Thanks, guys. And so short interval, only good for pump and dump scalping. Yep, exactly. And these little tiny range bar charts are tough too. This Russell I've got on the range 25, and it seems to slow down a little bit. It's not so bad, but I don't know. I like range bar 6 when the markets are not moving so wild and crazy. That's the one I've kind of settled on. I kind of like the range bar 6, and I do that at 10 o'clock, 11 o'clock. Those are kind of the time frames I like to trade, and range bar 6 seems to be pretty good on those. So, all right, guys, we will catch you guys tomorrow. Actually, tomorrow's Saturday. Today's Friday. I might be off Monday. I don't know if I'll make it back in time to be here Monday. So watch for your notifications on YouTube, and we'll see if we'll make it on Monday. But I'm traveling, and so I'm not sure if I'll make it on Monday. If not, we'll see you on Tuesday.